Welcome to Intelligence Gateway.
Hello. Today we are going to learn financial forecasting and budgeting in Financial Analyst. Financial forecasting and budgeting is the third module of this course. Introduction to financial forecasting. Financial forecasting is the process of estimating or predicting future financial outcomes based on historical data, trends, and relevant information. It plays a crucial role in strategic planning, budgeting, and decision-making for businesses, individuals, organizations. The primary objective of financial forecasting is to provide insights into future financial performance, enabling stakeholders to make informed decisions. By analyzing past financial data, market conditions, and other relevant factors, financial forecasts aim to project future revenues, expenses, profits, cash flows, and overall financial health. Here are some key aspects and steps involved in financial forecasting. Setting objectives. Clearly define the purpose and scope of the financial forecast. It could be short-term, monthly or quarterly, or long-term, annual or multi-year. Gathering historical data. Collect and analyze relevant financial data from the past. This includes financial statements, such as income statements, balance sheets, and cash flow statements, as well as any other pertinent information. Identifying trends and patterns. Examine historical data to identify patterns, trends, and relationships that can provide insights into future financial performance. This may involve analyzing sales growth, seasonality effects, market conditions, and other factors impacting financial outcomes. Selecting forecasting methods. Choose appropriate forecasting methods based on the available data, the nature of the business, and the forecasting objectives. Common techniques include time series analysis, regression analysis, qualitative methods such as expert opinions or market research, and quantitative models. Building the forecast. Apply the selected forecasting methods to generate the financial projections. This involves using statistical techniques, mathematical models, and assumptions to estimate future revenues, costs, and other financial variables. Reviewing and refining. Evaluate the accuracy and reliability of the forecast by comparing it with actual outcomes. Continuously monitor and update the forecast as new information becomes available. Adjusting for any changes in assumptions or market conditions. Communicating the forecast. Present the forecasted financial outcomes in a clear and understandable format to stakeholders such as management, investors, lenders, or internal teams. Effective communication of the forecast helps in decision-making and planning processes. It's important to note that financial forecasting is not an exact science and involves uncertainties and risks. Factors such as economic conditions, market fluctuations, regulatory changes, and unforeseen events can impact the accuracy of forecasts. Therefore, regular monitoring, flexibility, and periodic updates are essential to adapt to changing circumstances and improve the forecasting process. Overall, financial forecasting provides valuable insights into the future financial performance of an entity, enabling stakeholders to make informed decisions, allocate resources effectively, and plan for the future. Techniques for revenue forecasting. There are several techniques commonly used for revenue forecasting, depending on the nature of the business, available data, and forecasting objectives. Here are some commonly used techniques for revenue forecasting. Historical data analysis. This technique involves analyzing past revenue data to identify patterns, trends, and seasonality. By examining historical revenue performance over a specific period, you can project future revenue based on past growth rates or seasonality effects. This approach assumes that historical trends will continue into the future. Market research and customer surveys. Market research and surveys can provide valuable insights into customer preferences, purchasing behavior, and market dynamics. By gathering data on customer demand, market trends, and competitive landscape, you can estimate potential market size and customer adoption rates, leading to revenue forecasts. Time series analysis. Time series analysis uses statistical methods to analyze historical revenue data and identify underlying patterns and trends. Techniques such as moving averages, exponential smoothing, or regression analysis can be applied to project future revenue based on historical patterns and relationships. Market segmentation. If a business operates in multiple market segments or customer segments, revenue forecasting can be done separately for each segment. This approach considers the unique characteristics, growth rates, and market conditions of each segment to estimate segment-specific revenues. These individual segment forecasts are then aggregated to derive overall revenue projections. Sales pipeline analysis for businesses with a well-defined sales process. Analyzing the sales pipeline can provide insights into future revenue by examining the status and probability of closing deals at different stages of the pipeline. You can estimate potential revenue based on historical conversion rates and the size of the pipeline. Industry and economic indicators. Revenue forecasts can be influenced by broader industry trends and economic factors. Monitoring industry indicators such as market growth rates, consumer spending, or macroeconomic indicators can help in forecasting revenue by considering the overall industry, environment, and economic conditions. Expert opinions and market intelligence in certain cases. Expert opinions and market intelligence from industry experts, consultants, or market research firms can be valuable sources of revenue forecasting. These experts can provide insights into market trends, emerging technologies, or industry disruptions that can impact revenue. It's important to note that revenue forecasting is subject to uncertainties and assumptions. Therefore, it's recommended to use multiple techniques, consider different scenarios, and validate them. Forecast against actual results to improve accuracy. Additionally, revenue forecasts should be reviewed and updated regularly as new information becomes available or market conditions change. Expense forecasting and cost analysis. Expense forecasting and cost analysis are essential components of financial planning and management for businesses. They involve estimating future expenses and analyzing costs to understand their impact on the financial performance of an organization. Expense forecasting. Expense forecasting involves projecting future expenses based on historical data, anticipated changes, and business plans. It helps businesses anticipate and plan for upcoming costs, allocate resources efficiently, and set realistic budgets. Here are some key steps in expense forecasting. Review historical data. Analyze past expense data to identify patterns, trends, and seasonality. Consider different expense categories, such as payroll, rent, utilities, marketing, and supplies. Consider business plans. Take into account any planned business initiatives, expansions, or changes that may impact expenses. For example, if you plan to open a new location, you'll need to estimate the associated costs. Factor in inflation and price changes. Consider the impact of inflation and potential price changes for goods and services. Adjust historical data and estimate future expenses accordingly. Consult with department heads and managers. Collaborate with department heads and managers to understand their operational needs and get their input on expected expenses. They can provide insights into department-specific costs and any upcoming projects. Use forecasting techniques. Apply forecasting techniques such as time series analysis, regression analysis, or qualitative methods to project future expenses. These techniques can help identify underlying trends, relationships, and future cost drivers. Monitor and update. Regularly monitor and update expense forecasts. As new information becomes available or business conditions change, adjust forecasts based on actual results and refine the forecasting process over time. Cost analysis. Cost analysis involves examining the various costs incurred by business to understand their composition, efficiency, and impact on profitability. It helps in identifying cost saving opportunities, improving cost structures, and making informed decisions. Here are some steps involved in cost analysis. Identify cost categories. Identify and categorize different cost types, such as direct costs, e.g., raw materials, direct labor, and indirect costs, e.g., overhead. Administrative expenses. Calculate cost per unit. Determine the cost per unit of your product or service. This can be done by dividing the total cost by the number of units produced or services delivered. It helps in assessing the cost efficiency and pricing strategies. Cost breakdown and allocation. Break down costs into various components such as materials, labor, overhead, and analyze their respective contributions to the overall cost structure. Allocate costs accurately to different products, services, or projects. Cost variance analysis. Compare actual costs with budgeted or standard costs to identify any variances. Analyze the reasons behind cost deviations and take corrective actions if necessary. Cost volume profit CVP analysis. Perform CVP analysis to understand the relationship between costs, volume, and profitability. This analysis helps in determining the break-even point. Assessing the impact of volume changes on costs and profitability and making pricing decisions. Benchmarking and comparison. Compare your costs with industry benchmarks, competitors, or similar businesses to assess your cost competitiveness and identify areas for improvement. Continuous improvement. Continuously evaluate cost-saving opportunities, process efficiencies, and cost control measures. Regularly review cost analysis results, implement cost-saving initiatives, and monitor their effectiveness. Expense forecasting and cost analysis provide valuable insights for financial planning, budgeting, and decision-making. They help businesses anticipate and manage expenses effectively, optimize cost structures, and improve profitability. Creating a financial budget and variance analysis. Creating a financial budget and conducting variance analysis are important financial management processes that help businesses plan, monitor, and control their financial performance. Here's an overview of these two processes. Creating a financial budget. A financial budget is a quantitative plan that outlines projected revenues, expenses, and cash flows for a specific period, typically 1 year. It serves as a roadmap for financial operations and guides decision-making. Here are the key steps involved in creating a financial budget. Revenue forecasting. Estimate expected revenues based on historical data, market trends, sales projections, and other relevant factors. Consider different revenue streams and their associated growth rates or pricing strategies. Expense estimation. Project anticipated expenses across various categories, such as payroll, rent, utilities, marketing, supplies, and overhead costs. Consider historical data, upcoming initiatives, inflation, and other relevant factors. C. Cash flow projection based on revenue and expense estimates. project the expected cash inflows and outflows throughout the budget period. This helps in managing cash flow requirements and identifying potential cash gaps or surpluses. D. Budget assumptions. Document the assumptions and key drivers behind the revenue and expense estimates. These assumptions should be realistic, based on historical data, market conditions, and informed judgments. E. Budget allocation. Allocate the projected revenues and expenses to different departments, projects, or cost centers within the organization. This helps in establishing accountability and responsibility for financial targets. F. Budget approval. Present the budget to management or stakeholders for review and approval. Consider any feedback or adjustments required before finalizing the budget. Variance analysis. Variance analysis involves comparing actual financial results against the budgeted or planned figures to understand and analyze the differences. Variances. It helps in identifying performance gaps, assessing the effectiveness of the budget, and taking corrective actions. Here's how variance analysis is typically conducted. A. Gather actual financial data. Collect the actual financial results for the budgeted period. This includes actual revenues, expenses, and cash flows. B. Calculate variances. Calculate the differences between actual results and budgeted figures for each line item. Compute both the dollar amount of the variance and the percentage variance. C. Analyze variances. Investigate the reasons behind the variances. Identify the factors that contributed to the differences, such as changes in sales volume, price fluctuations, cost overruns, or unexpected expenses. Consider both favorable and unfavorable variances. D. Assess significance. Evaluate the significance of each variance by considering its impact on the overall financial performance and the organization's goals. Focus on variances that are material or have a significant impact on profitability or cash flow. E. Communicate and report. Prepare variance analysis reports and communicate the findings to management or relevant stakeholders. Clearly explain the reasons for variances, their implications, and any recommended actions. F. Take corrective actions based on the analysis. Develop and implement appropriate corrective actions to address unfavorable variances or exploit favorable variances. This may involve adjusting operations, revising budgets, reallocating resources, or modifying strategies. G. Continuous monitoring. Regularly monitor and review variances throughout the budget period. Update forecasts and budgets as needed based on actual results and changes in market conditions. Creating a financial budget and conducting variance analysis help businesses align their financial activities with their goals. Identify areas of improvement or concern and make informed decisions. These processes enable effective financial planning, performance evaluation, and control over financial outcomes. Sensitivity analysis and scenario modeling. Sensitivity analysis and scenario modeling are two techniques used in financial analysis and decision-making to assess the impact of uncertainties and changes in key variables on the financial performance and outcomes of a business. They help organizations understand the range of possible outcomes and make more informed strategic and operational decisions. Let's delve into each of these techniques. Sensitivity analysis. Sensitivity analysis examines how changes in one or more independent variables, also known as input variables, impact the dependent variable output variable, such as financial results or key performance indicators. It helps quantify the sensitivity of financial outcomes to variations in these variables. Here are the steps involved in sensitivity analysis. A. Identify key variables. Identify the independent variables that have the most significant impact on the financial outcomes. These variables can be related to sales volume, pricing, costs, interest rates, exchange rates, or any other factors that are critical to the financial performance. B. Define scenarios. Determine the range and magnitude of changes. For each key variable, create multiple scenarios that represent different possible outcomes or changes in these variables. For example, consider optimistic, pessimistic, and base case scenarios. C. Assess impact. Quantify the impact of the changes in each variable on the financial outcomes. Use sensitivity analysis techniques such as one variable at a time analysis, or more advanced methods like Monte Carlo simulation, to evaluate the sensitivity of the outcomes to the variables. D. Interpret results. Analyze the results of the sensitivity analysis to understand which variables have the most significant impact on the financial outcomes. Identify which variables are most sensitive and require attention in decision-making processes. Incorporate findings. Use the insights gained from the sensitivity analysis to make better informed decisions. Consider strategies to mitigate risks associated with sensitive variables, or exploit opportunities identified through the analysis. Scenario modeling. Scenario modeling involves creating multiple plausible scenarios to assess the potential impact of various combinations of uncertainties or events on the financial performance of a business. It helps in understanding the range of potential outcomes and evaluating the robustness of strategies under different circumstances. Here are the steps involved in scenario modeling. A. Identify scenarios. Identify different plausible scenarios that capture a range of possible future events or conditions. For example, consider scenarios such as economic recession, market expansion, regulatory changes, or technological disruptions. B. Define assumptions. Define the key assumptions for each scenario, including variables related to market conditions, customer behavior, costs, competition, or any other factors relevant to the scenarios. C. Quantify impact. Assess the impact of each scenario on the financial performance by analyzing how the assumptions affect revenues, expenses, cash flows, profitability, or other relevant metrics. This may involve adjusting financial models or using simulation techniques. D. Evaluate strategies. Evaluate the performance of different strategies or decision options under each scenario. Assess how well each strategy performs and identify which strategies are robust and resilient across multiple scenarios. E. Risk mitigation. Identify potential risks and uncertainties associated with each scenario. Develop contingency plans or risk mitigation strategies to address potential challenges and seize opportunities presented by each scenario. F. Decision-making. Use the insights gained from scenario modeling to inform decision-making processes. Consider the risks, opportunities, and trade-offs associated with different scenarios when formulating strategies or making resource allocation decisions. Sensitivity analysis and scenario modeling are powerful tools for evaluating the impact of uncertainties and alternative scenarios on financial outcomes by considering different possibilities and assessing their implications. Organizations can make more informed decisions, manage risks effectively, and plan for the future.
Thanks for watching. For more information, like, comment, and subscribe our channel.